Hello, everybody, and welcome to the Klaas Financial 2022 Year in Review Quarterly Webinar. Thank you for joining us today. My name is Joshua Stirling, Portfolio Manager here at Klaas. Before we get into it, we'd like to do a bit of housekeeping in the beginning. So today, you can expect that our webinar is going to last about 25 to 30 minutes. At the end today, we're going to have a Q&A session. If you have any questions throughout the contents that we present today, go ahead and click the Q&A button at the bottom of your screen at any point in time, and we'll address it at the end today. Joining me today, I have Eric Schwartz and Kite, who's our CFO. Today, we'll be talking about quite a few topics. We'll talk about what's happened in 2022, and then we'll also talk about kind of where we are in the economy today. And then we'll take a little trip into history, and we'll look at what's happened in the past, maybe what the Fed can take lessons from what's happened historically. Also, a little history to Klaas Financial. So we've been in the business now for almost 50 years. We have two offices. We have one here in Madison, Wisconsin, and then we have one in Rockford, Illinois. But we do work with clients all across the US, over 30 states. We help individuals, families, corporations, and foundations invest and plan for the future. Mainly, we focus on retirement planning with our individuals and families. So Kyle, a lot's happened throughout 2022, the last 12 months. Can you kick us off by talking about what's happened so far this year?
Yeah, no problem, Josh. Before we get into 2022, let's go back to 2021 and think back that far. Well, we're really focused on late 2021, so I call it fourth quarter. This is when we were really starting to come out of the pandemic. Everybody was kind of itching to go because we had all been putting off our travel plans and family get-togethers and all that kind of stuff. So everybody was, like I said, getting ready to get back out to whatever our normal was going to be. The stock market was doing really well. It was closing near all-time highs at the end of 2021. And then also in that time frame is when we heard the now almost infamous term from the Fed that inflation was transitory. Looking back, they clearly made a mistake there. But when they said that, that's the reason why there was no thought of any interest rate hikes or anything like that back then. But that soon changed very, very quickly, and the market started turning around in early January here. So. Go ahead, Josh. There we go. Perfect. So let's take a look at what happened in 2022 here. So this is for the calendar year that we'll kind of start at the top and work our way down. So the Dow Jones Industrial Average, for those of you that are unfamiliar with that, that's kind of the big one that everybody pays attention to on the news at night, comes around across on the ticker. It is only about 30 of the largest companies around, but you can see that it was down about 7%. So all those 400, 500, 600 point swing days all added up to about a 7% downturn. That's actually not too bad when you start looking at some of the other indices here. Part of the reason why that one was down a little bit less than others is because there are some energy companies that are tied up in that, and energy was one of the few asset classes that actually did pretty good. We'll go down to the other side, which is the NASDAQ composite. That one's down 33%. That is your tech companies, your Apples, your Amazons, your Googles. They're in some of these other ones as well, but that's very tech focused. And you can see that took the brunt of the downturn there. And then if you go one up from that, you've got the S&P 500. That is probably a better overall feel of the U.S. economy because that is your 500 largest companies. So that's an 18% downturn. So again, not a great year on any of these indexes, but what we'll really focus on today is going to be the global 60-40 portfolio. That's kind of the benchmark for what a balanced portfolio is considered. You can see that that was down 16% last year. So many of our clients are in a strategy similar to that. So that's kind of what you were feeling. And you can see most of the reason that was because you had the S&P 500 down, but you'll also notice that the Bloomberg Aggregate Bond Index was down 13%. So congratulations, everybody. You just lived through the worst year in bonds in over 100 years. The last number I heard was the worst year since 1780 something. So that is really what really pulled down the 60-40 portfolio, is that bonds were not the actual hedge that they usually are when we go through things like this.
Yeah. I think we'll probably talk a little bit about interest rates, inflation throughout the rest of this conversation today. But one of the things that really struck me as interesting is that all the indices really moved differently this year, which was kind of surprising because it felt like over the past 10, 12 years, you really saw them just trending upwards together and they all kind of tied in together. But the NASDAQ really got hit hard this year with the significant rise in interest rates. Those tech companies really took the brunt of it. And you see these value companies in the Dow Jones, the manufacturing focused, really outperformed today.
Yeah, I think we tend to talk about them in groups, right? We talk about them as stocks or equities and fixed income. But this year it really mattered where you were invested, which is again the reason that our global portfolio, well, all of our portfolios are going to be globally diversified. But this was a tough year for our moderate investors. They're not used to seeing, a 60-40 portfolio is a moderate mix, and we're seeing it down 16% with bonds struggling. So to all our clients listening, we understand it was a bit of a tough year.
Yeah, it was actually one of the worst years for a 60-40 portfolio. It was the worst year since the Depression for a 60-40. And what I've seen is it's going to be go down as one of the worst three of all time for a 60-40 type portfolio. So it was not a pretty year for that portfolio at all.
We unfortunately don't have any of the numbers that have happened since the beginning of the year, but they're all good. Really good start to the year. So hopefully we've put that pain in the rearview mirror.
Yeah.
So Eric, we're talking about what's been happening so far in the past. And today the big conversation is around inflation. Can you take us through what's been happening with that recently?
Yeah, today and the last 12 to 18 months, it feels like we've been talking a lot about inflation. Specifically on this webinar, at least the last 3 or 4, we've been highlighting it. But we are thinking about inflation not only because it damages purchasing power for folks, but also because it's basically what the Federal Reserve is paying a lot of attention to right now in their interest rate policy. And we'll get into that in more detail as we go along here. But what we saw is the Federal Reserve basically begin to realize that inflation was not, in fact, going to go away on its own. And March, they just started to raise interest rates in an effort to kind of pull down inflation. And it took a few months, but we did see it peak at about 9% back in June. And we've been on somewhat of a downward trend since then. And this obviously is great from a spending standpoint, getting costs down. But the market is also hoping that it informs the Fed's policy and allows, at least long term, gets the rate hikes to slow down a little bit.
Yeah. Well, when I look at this graph, I immediately go right towards the big slope up in March. And I guess looking backwards, we can really all agree that the Fed was late in addressing inflation. They should have been further ahead of inflation and taking care of it and trying to stamp it out instead of saying that it was a transitory thing and that it was going to go away on its own. It obviously has not. And we've been paying a lot of repercussions because of that.
Yeah.
But our response has been really good since then. It's been painful, but it's been a necessary pain to kind of take care of it.
Yeah, they really had to play catch up. I mean, they clearly missed the boat. And looking back, hindsight's always 2020. We had a perfect storm for inflation. I mean, you had the global supply chain shut down for almost 2 years, essentially. So you had less goods in the market, and then we influxed a bunch of money into the system. So more money chasing less goods. I mean, that's economics 101, supply and demand, right? So you're going to drive prices higher. So fortunately, they caught it as earlier than they could have, but they definitely missed the boat at the first part. So hopefully, that's why they've been so aggressive in rate hikes, and that's really what led to such a bad year for bonds, is that they were trying to play catch up, and they did some of the most aggressive rate hikes we've ever seen because they knew that they had to catch up. So.
Well, let's go ahead and dig into a conversation that focuses a little bit more on the bond portfolio. Last time in our quarterly webinar, we took some time to talk about theoretically what's been happening and what your bond portfolio could look like going forward and how coupon payments could increase and become better. Today, we want to look at what happened over 2022 and reflect on what happened in the bond portfolio and what's actually been happening to coupon payments. So on this slide here, to briefly explain the graph, concentrate on the blue line at first. This is a $100,000 bond portfolio. It is following the Bloomberg Barclay Aggregate Bond Index. And starting out at the beginning of the year, we have a $100,000 portfolio. And with all the interest rate hikes throughout the year, it really hammered the portfolio down to, at the end of the year, about $90,000. And that's really painful in the moment. It takes the brunt of the interest rate increases over that year period. But the other thing I'll have you concentrate on is the bars going across the screen as well. And we're going to look at specifically the green bars. So starting at the beginning of the year, that $2,400 number, that's the annual coupon payments that you would have received out of that portfolio at the beginning of the year. And as that portfolio has gone down throughout the year, those coupon payments actually went up. And it's dollar for dollar. That's the actual dollar amount you're getting out of your bond portfolio during that time frame. So by the end of the year, we're up to about $2,800. And that might seem like a small jump, but when the bond portfolio is going down like that, and you're receiving higher coupon payments, it's showing that we're kind of moving to this new era of bonds. It's almost like we're jumping back into the 80s and the 90s when bonds actually had good returns. And that can be really meaningful going forward in bond portfolios and what kind of return you can expect from it.
Yeah, I think we get caught up a lot of times in what the stock market is doing and how it's impacting portfolios. But people forget, we own bonds not just for stability, but also for interest and for income. And the bonds that you own or that our clients own in their portfolios, they are securities that are paying interest on generally a monthly basis. And as interest rates rise, the rate that is paid on those new bonds that are issued is also rising. So Josh is showing us here just the impact of those thousands of bonds that our clients own in their portfolio. They're constantly coming due and basically being rolled into new bonds. And over the last 6 months, as rates have come up, we're seeing that the overall interest that is being paid on the whole portfolio is slowly coming up as well.
From here on out, bonds are going to act in two different ways. One, they're either going to get impacted by inflation or interest rates. And if interest rates end up going down, well, the bond portfolio is going to go up in market value. That's just the nature of how bonds work with interest rate hikes and declines. The other thing that will happen is if interest rates kind of stagnate, go on for a while, the shorter maturity or the bonds that are coming due sooner will roll off. Those dollars that you reinvest back into the bond portfolio will now be reinvested at higher interest rates. So right now we're in a pretty good position for the future of bond portfolios. So we're going to take a bit of time here and
yeah, we're gonna look at first another one of the consequences of the Fed's interest rate hikes, and that's the it seems like constant chatter of recession, right? And one of the responses we've seen is sort of a parade of layoffs. What we're seeing on the screen here is 4 very well-known tech companies and the amount of the percentage of their total workforce that was they've announced they're going to lay off or already have. One thing we've seen here is this has been very focused in the tech sector, which, I mean, some of that is likely overhiring during the pandemic in response to pandemic demand, and now sort of right-sizing the workforce to some extent. But there's no question that the recession discussion and the headlines are unsettling for businesses, and they are starting to think about getting a little bit leaner. But on the other hand, we're also seeing some bright spots at the same time. We had really strong GDP numbers in the fourth quarter just come out here in the last couple of days. Unemployment remains very low. And I actually saw, I think this week for the first time, wage growth over the preceding 12 months actually finally surpassed inflation. So rising wage growth all at the same time. So, we're getting a lot of mixed messages, but there's no doubt that for everybody seeing these every day, it's definitely unsettling.
Yeah, and this is part of where you hear the talk of we might pull off a soft landing. This is kind of what they're referencing, is that the jobs market is actually holding up pretty well. And obviously, if people can keep their jobs, they'll keep making their mortgage payments, they'll keep making their car payments, all that kind of stuff. So like I said, when you hear that talk of soft landing, it's more has to do with that even if we dip into a recession, the job market isn't going to get wrecked and we have mass layoffs or anything like that. So
That's not to say that people aren't being impacted.
Right.
That's definitely the case. I've started hearing about friends, family. A lot of those are in tech sector jobs, but it seems like it's starting to spill over a little bit. Hear a little bit more every now and then, but for the most part, it really seems to be focused on the tech sector.
Yeah. And the tech sector has always been very dependent on cheap money and low interest rates, right? That as borrowing gets more expensive, I don't think anybody was expecting them to continue to grow the way they have in recent years.
So we're going to go ahead and take a look kind of down the past. We're going to look at some of the things that the Fed has done in the past for lessons for the future and the way that the Fed's had to kind of react in this current environment. But to set the stage a little bit before we get there, talking about the Fed's role today, they're at kind of a pivotal moment right now, and we're hearing a lot about it in the news. We're hearing a lot from the market. We're hearing a lot from businesses. And they are loud and clear. They want the Fed to slow down and stop raising interest rates, and potentially even at the end of the year, start to bring them down. And the reason you're hearing that is they're trying to essentially pressure the Fed into making this shift to change it. And it's because it's become so expensive to borrow. This is a very purposeful design by the Fed, and really the biggest tool that they have in their toolbox to addressing some of the concerns in the environment that we're in. So on the screen right here, we have a targeted slowdown. What different areas the Fed's interest rate increases really impact. From corporations, it really has to do with new projects, hiring, and even laying off workforces that they maybe hired on way too quickly and are maybe a little bit bloated today. But from the individual and family level, you have big purchases that are kind of being reconsidered. The housing market has definitely slowed down. People maybe aren't buying as many cars nowadays. So it's really impacting everything we're doing today. And it's painful right now. But looking to the past, we can kind of see why doing this today is really important. And if we don't take care of it today, it can really impact us far in the future. And by far in the future, it's only about maybe 12 months away if we don't get inflation kind of taken care of. So looking to the past, back in the 60s and kind of leading into the 70s here, we were in an interesting environment. There were a lot of pressures happening. The government was spending a lot. We were running a deficit from things like the Vietnam War. The government was spending money with the Great Society coming out. And then even in the 1971, the dollar, which used to be convertible into gold, was written out and no longer able to be done so. And as we hit 1970, all these factors and a lot of others started to cause inflation to rise. And it started to hit about 5% and jumping over it a little bit. Throughout the rest of the 70s, really common things that happened were energy crises, where the 1973, the Arab oil embargo happened, and that caused an oil shock and a spike in the price. And then in 1979, we had the Iranian Revolution. Between this time period, between 1973 and 1979, the cost of gas grew 11-fold. And it was a really big impact to Americans and everybody having to wait in line to go get your gasoline every morning. But today, gas or oil, 1 barrel of oil costs about $80. Back then, it jumped from 1973 from $3.50 all the way up to $40 in a period of 6 years. That would be a really hard environment to see today. But all these things led to really significant inflation. By the end of 1970s, in 1980, inflation peaked at 14.5%. So the Fed during this time should have been addressing this issue. But back in the 1970s, Arthur Burns was the head of the Federal Reserve. And the belief back then was that full employment was first and foremost what they should take care of. Federal Reserve is supposed to have a dual mandate where they, one, take care of full employment, making sure that the unemployment rate is low, typically around 4 or 5%, even 6%. But then they're also supposed to make sure that there's not significant price pressures, that inflation is taken care of. But it wasn't really believed that some of these situations that were happening were within the control of the Federal Reserve. In addition to that, they had these pressures that businesses and markets were demanding for that we are seeing today. They wanted access to cheap, easy money to take out loans and finance different purchases. But they fell to the pressure back in the 1970s, and they didn't raise interest rates fast enough. And so throughout the 1970s, inflation actually peaked out at 12% in 1974. And at this time, they recognized that they absolutely had to take care of this. And so interest rates did actually increase, but as they dropped down, inflation dropped down to about 5% in 1977. And then William Miller stepped in to take over. He was a businessman, and he did not want to raise interest rates. And unfortunately, right after he took the helm, inflation came soaring back. He was only there for about 17 months. He was very quickly removed after he voted with a minority of the board of governors of the Federal Reserve and didn't vote to raise interest rates. And so by the time he left, inflation had gone from 6% all the way up to 13%. Thankfully, we had Paul Volcker step in, and he had a mindset where he wanted to take inflation and get it all taken care of. And by 1980, he had raised interest rates significantly, and it did put the US into a recession, a deep recession throughout 1981 and 1982. Like I said earlier, inflation peaked out at 14.5%. Interest rates had to be risen to about 20% at one point in time. And this caused a lot of chaos in the economy. Unemployment rose up to 11% during this recession. But by the end of 1982, inflation dropped down below 5%. It finally took care of the problem, but with a lot of pain. So looking at what individuals went through during that time frame. During that time frame of the Great Inflation between 1972 and 1982, you actually would have received a pretty good return on your stocks and bonds. But when you actually account for inflation, it was a painful time period. Your money grew, but it didn't buy you more stuff. And for people who at that time were in retirement and needed that money to be able to live, it was a really challenging environment to be able to survive. But luckily, in today's environment, the Fed is looking at this situation very seriously, and they have an important decision to make in 2023, which is how are they going to address interest rates and try to avoid the situations that we had in the 1970s and 1980s. And they've already taken steps to do that. Throughout 2022, rising interest rates so aggressively and so quickly. It really leads us to a place where we might go through some temporary pain, but hopefully we will not have to go through multiple years of double-digit inflation.
Yeah, I think Chair Powell has, I mean, it's never a popular decision to raise interest rates for the most part, for all the reasons you've talked about, Josh, but everything he has said and hinted at, that the Board of Governors is very, very good at hinting at things and moving the market. But everything he has said is suggests a commitment to making sure that we tamp out inflation and don't give up too easily or too early, I guess, is a better way of saying that.
Yeah, they're walking a tight rope. Obviously, we've got to get this under control, but then you're also trying to not go so far. And it's kind of interesting when you think back to these interest rates. And, you know, a lot of you on the call remember the 80s, that maybe you bought your first house in the 80s and you were getting 15% on CDs, but your mortgage was 12%, right? So some people think those were like the good old days when you could get easy interest, but this is why it's not always what it seems, because you had inflation running really, really high during that time as well. So, and even, you know, where we're at now, 5-6%, that's not historically high interest rates by any stretch of the imagination. So yes, it's a lot higher than what it was, you know, 18-24 months ago, but we were really at the bottom as far as record low interest rates back then. So they're just trying to find that balance of whatever a normal interest rate environment looks like, because it's been a long time since we've been in a normal interest rate type environment.
So Eric, we've talked about some very heavy hitting stuff. Can you finish us on maybe a lighter topic?
Yeah. I feel like every quarter we get on here and we have a lot of data for everybody, and we talk about some really high level thinking. And then we come to me at the end to just say, all right, well, I'm here to be the broken record again. But as at Klaas, we are a planning first organization. We have obviously a very talented portfolio management group that we depend on to manage our clients' money. But our primary focus in working with clients is to do financial planning in conjunction with the asset management. And we build plans for clients to be able to weather tough stretches. We haven't had very many of them in the recent past here, but as we are building out plans, we are doing so with the expectation that we will have stretches like this. And we can develop a plan and make sure that clients are properly funded. But what we can't control or plan for is the abandonment of that plan, right? So for people who are really stressed because the portfolio isn't doing well and maybe they decide to bail and move to cash or something safe, well, that over the long term has really negative impacts on your financial security. So I'm going to come back and say it again. The most important thing you can do through these times is stay the course and trust the process. We've been doing this for a long time, and we've seen it work. Our clients retire once. We retire with people every single day. So as hard as it is, that is the best advice we can give.
And it's very hard psychologically. We understand it, right? And Eric and I have these conversations all the time. Clients come in, oh, what should I do? What should I do? And sometimes we tell them the opposite of what they thought because they think they want to get more conservative and this and that. But at the end of the day, what you want to do, and we all know this, we've all heard the adage, right, is buy low and sell high, right? So again, psychologically, as human beings, that is the hardest thing to do, is actually get more aggressive or stay the course. We all want to hit the panic button and say, oh, this is as worse as it's ever been, and I'm never going to recover from this, right? But again, history just gives us context that we've been through things like this before. It's not going to last forever. We will come out the other side. And like Josh was saying, the balance type portfolios are actually looking pretty good for whenever we get to the other side of this thing. Now we'll be actually making some interest on bonds, and you've got stocks recovering from a down year. So it is just so important to control what you can control, which is, your spending and things like that. None of us know what the Fed's going to do 100% or can predict the market with 100% accuracy. So you just got to stay the course and trust in the plan, and obviously be flexible. When you have flexibility, that makes going through these times a lot easier. So,
all right.
And we understand that's not a satisfying response. We totally get that. I think, Kyle, what we hear most often is people come into meetings and they feel like we need to do something,
right,
whatever that is, right? Because something is happening that's causing stress and we need to do something about it. Where often the best thing we can do is nothing in those moments and just continue with the process, continue allowing the market to do what it's going to do, because we have a lot of history on what that looks like over a long period of time. And again, that's what we build the plans based off of.
Yeah, it's very important. Like we said, it's if your plan hasn't significantly changed, meaning you haven't, massively changed your lifestyle or anything like that, then you probably don't need to be messing with your investments just because we're going through a downturn or something like that. And, certain sectors of the economy needed to get slowed down, which housing was one of them. Housing going up 20% year over year is not sustainable. That's one of the things that rising interest rates is obviously going to take care of the fastest, which most of us have already seen that's actually starting to happen, which is not necessarily a bad thing. Yeah, it's a little more expensive to get into a house, but you can argue that was actually something that really needed to be done. So,
yeah.
All right. Well said. That was excellent. Well, we'll go ahead and move into the Q&A session here. We have a few questions here, so we'll take a look here. Kyle, I'll ask you this one. Why are significant rate rises not working yet?
Well, it's kind of what I just mentioned. The things that they impact the most when interest rates rise like this is obviously businesses, their access to capital goes down. But as far as consumers go, it impacts houses and car loan rates the most. and houses and cars aren't necessarily something that you buy every single year. So it takes time for those rate hikes to restrict the money supply in the system. So that is part of the reason why the market, especially in the fourth quarter, it was like good news as far as the economy is concerned, is actually bad news for the market, because they're worried that the Fed's going to go too far and not let what they've already done flush through the system, because it doesn't happen overnight. It takes a long time for them to get into the system.
Mm-hmm. Yeah. All right. The next question that we have, Eric, I'll ask this to you, but I can also help you out with this one. Are we headed into a recession with an inverted yield curve? Which I think is an interesting question. We haven't heard a lot of places talk about it a lot.
Yeah, I think we hear questions about this a lot, and I think that when people think of a recession, they immediately think of the Great Recession, right? We think of 2007, 2008, and I think obviously it was a huge event, and people remember that. But recession is a financial term for essentially 2 consecutive quarters of negative GDP growth. Well, we've seen that already, and we've seen the market get clobbered over the last 12 months. Whether the yield curve is a sign that things are going to suddenly get worse. I mean, I don't know, what would you say to that, Josh, from a portfolio management standpoint?
Well, I would say that over the next 3 to 6 months, be warned, you're going to see a lot of predictions on, is this a recession predictor? Historically, yep, the inverted yield curve has been one of the primary kind of focuses for recession predictors. But like Eric said, we've already gone through a lot of that pain already over the last 12 months. But yeah, it's going to be interesting seeing all the different types of kind of, is this going to be a false positive or a false negative? What's going to happen in the near term?
Yeah, I've seen something that 60 something % of economists are predicting a recession in 2023. So whatever that's worth. But you've got to remember too, that the economic data that an official recession call will be based on, is all backward looking, whereas the stock market's forward looking. So occasionally we have these periods where the stock market and the economy don't run in lockstep, because they're not the exact same thing. So it's very possible that the economic data gets worse, but you could see a recovery in the stock market, because it's already priced in a lot of bad data that they know is coming. So there's really just no way to position yourself just because it's an official recession or anything like that.
Right. Yeah, to that point, I mean, you think of coming out of the initial dive in the market post-COVID. I mean, the market starts rallying and basically gains back everything that it lost during a time when none of us knew what 3 months from now looked like, and the stock market is looking at future profits of the underlying stocks to price itself. And at that point in time, we didn't have any reason to believe that we would have normal corporate profits coming up in the near future. So,
all right, we have another question that came in. So I apologize, I'm going to paraphrase this one just a little bit here. But the housing industry was significantly impacted by interest rates during the last period where housing market tanked significantly back in 2008, 2009. Can you comment on the impact you've seen historically based on the health of the housing sector?
Yeah, it's a great question. So 2008 and 2009 is a really hard one to kind of use as a barometer because there was so much other stuff going on back then. I mean, for those of you that have seen the movie The Big Short or read about it, I mean, the mortgage industry was basically giving out loans to people's dogs, and it didn't matter. You didn't have to show income, you didn't have to show anything like that. So because of all that, there were a lot of kind of safeguards and rules put in place so that we didn't go through another one of those. So generally speaking, rising interest rates, obviously you're going to see home prices come down, because when most people go to buy a house, they know, okay, what's my monthly payment? This is what I'm going to base it on. And if you have more money going towards interest because your interest rate's higher, that means the less can go towards the principal of what you pay for the house and things like that. So I would say in general, rising interest rates are going to drive home prices down. But we also have a really short supply of houses. So to say that it's going to be, another 2008 and everything gets blown up and, neighborhoods just come to screeching halt where they just stop building in them, I don't know that we're in that scenario this time.
Yeah, to kind of expand on that, the big equation at hand is always supply versus demand. And right now we're in a very different environment. The buyers are quite different than the buyers back in 2008, 2009. And the people that already own homes don't have, they all have fixed interest rate loans. They don't have these variable loans that are going to go up as the Fed raises rates. And so when you look at this demand supply picture, like Kyle said, the supply is pretty low. The demand is still there. Even after interest rates have hiked way up, there's still demand for housing, and there's still people out there looking for houses. Some of the people have been weeded out because houses have become, yet again, even more expensive when you need to take out a mortgage. But there are still people out there looking to purchase homes. Maybe they're looking to put more down on a home, or maybe they're upping their limit, or maybe they're looking at a home that's a little bit cheaper. But that demand's still there, which is the big difference that we're seeing today versus back in 2008, 2009.
I think the other wrinkle that we've seen with just in the short run here, prior to rates rising and costs of homes rising, especially here in the Midwest. I mean, post COVID, a lot of people are now able to work remotely, and they don't necessarily need to live in, on the coast in more expensive places. They can move, to the Midwest or really anywhere and do their job from anywhere. And so you had a big influx of people coming to, places like Wisconsin and Illinois for a lower cost of living while they can still do their job. So that drove up costs as well. And I don't know that that's necessarily slowing down too much either. So a lot of differing factors that really make it, I think, a much different situation than we saw.
Yeah,
back in
sure.
2008.
Yeah.
All right, perfect. Well, that's all the questions that we have today. So we appreciate everybody joining us today. We appreciate your trust that you have in the Klaas team here. Thank you so much, and we'll see you again in one quarter.